Welcome back, hunters, to the Daily Hunt for Multibaggers, your go-to source for AI-generated insights into the market's hottest trends. I'm Ethan, your guide to growth and opportunity.
And I'm Brooke, here to keep us grounded with the cold, hard data. It's Wednesday, October 15th, 2025, and we're looking at the data collected yesterday, October 14th.
Well, today's scan of social media discussions flagged quite a few different stocks, signaling a really active and diverse market sentiment out there. We saw a solid mix of new names bubbling up and some familiar ones generating a lot of buzz.
That's right, Ethan. Our AI certainly had its work cut out for it. Overall, I'd say the market sentiment is a real mixed bag. There's a lot of promising optimism floating around some of these names, but our KPIs are also flagging some pretty significant risks for others. It definitely feels like a day where due diligence is more crucial than ever.
Absolutely. Let's dive right in, shall we? First up, we're seeing a lot of chatter around AST Space Mobile, Inc., ASTS. The user sentiment is incredibly bullish here, talking about massive gains, over 2,500% gains even for one user. There's a strong belief in significant future upside, especially with that big Verizon deal recently. People are really seeing this as a disruptive technology with huge potential, a real moonshot.
While that kind of enthusiasm is certainly contagious, Ethan, our KPIs for ASTS paint a very different picture. The net profit margin is at 0, earnings per share are a negative 1.86, and the operating margin is a deeply concerning negative 62.97. That means they're burning cash. The price-to-book ratio is extremely high at 27.29, suggesting this valuation is purely based on future speculation, not current assets. Plus, a debt-to-equity of 43.67 and a beta of 2.408 scream high risk and volatility. From our previous ratings, ASTS has consistently been in the speculative gamble or stay away category. On October 14th, it was a speculative gamble.
So, what's the verdict, Brooke?
Despite the community optimism and past gains, based on these financial fundamentals, our AI-generated insight for ASTS is to stay away. The risk simply outweighs the current financial stability.
Understood. Next, a big name, Alphabet Inc., GOOG. This one is generating some serious bullish vibes. Users are calling it their highest conviction stock, believing it's absolutely dominating in the AI game. They're actively accumulating shares, and honestly, with their recent AI and cloud collaborations and investments, it's easy to see why. Their revenue growth is a healthy 13.8%, and return on equity is an impressive 34.8%.
That 31.1% net profit margin and 9.43 EPS are certainly very strong, Ethan, showing excellent operational efficiency. However, the stock is trading close to its 52-week high, and while the PE of 26.20 isn't exorbitant for a tech giant, it does price in continued growth. For GOG, our previous ratings have bounced a bit between buy and stay away, with the last one on October 8th being a stay away.
So, considering the AI dominance and those strong financials,
given the robust profitability and strategic positioning in AI, our AI-generated insight for GOG today is a buy. This is an upgrade from its last stay-away rating.
Great news for GOG. Moving on, let's talk about Lithium Americas Corp., LIC. We saw some posts highlighting some serious gains. One user reported a $15,000 gain and said it was looking moist. Another post celebrated a whopping 570% in 3 months. There's certainly some excitement around rare earth exploration and a favorable geopolitical environment for mining stocks right now.
And that's fantastic for those who've made those gains, Ethan. But for new investors, LAC presents some serious red flags. The company is currently unprofitable, with EPS at -0.3 and a net profit margin of 0. Critically, the debt-to-equity ratio is an extremely high 19.95, indicating heavy reliance on debt. Also, the return on equity is negative. While the stock is near its 52-week high, its beta of 3.447 suggests extreme volatility. This stock has consistently been a speculative gamble or stay away in our previous analyses, and that hasn't changed.
So, a high-flying stock, but with some fundamental challenges.
Precisely. Our AI-generated insight for LAC is to stay away. The underlying financials don't support the speculative momentum.
Next up, advanced micro devices, AMD. There's a lot of bullish sentiment around AMD, especially with their huge deals, like the one with Oracle for 50,000 AI chips and another with OpenAI. Users are betting big on its future, and the company has shown strong revenue growth of 31.7%. It seems like a major player in the AI chip space, really challenging Nvidia.
I hear the enthusiasm, Ethan, but the KPIs for AMD are screaming caution. Despite the positive news, the user sentiment in one thread was actually quite skeptical about the stock's reaction. The PE ratio is an exceptionally high 129. This means a tremendous amount of future growth is already priced in. Coupled with a very high debt-to-equity of 6.513 and a negative operating margin of 0.0125, this is a risky proposition. The stock is near its 52-week high. AMD has been a consistent stay away in our past ratings.
So, even with those big AI deals?
Even with the exciting AI deals, the valuation is simply too stretched and the debt too high. Our AI-generated insight for AMD is to stay away.
All right, moving on to another AI powerhouse, Nvidia Corporation, NVDA. There's undeniable strength here, Ethan. Revenue growth is a staggering 55.6%, and the net profit margin is over 52%. Analysts are bullish, maintaining overweight or buy ratings. They're at the forefront of AI, and their impact is just immense.
While those growth and profitability numbers are indeed phenomenal, the sentiment we picked up also hinted at AI bubble concerns. The PE ratio is a very high 51.29, and the price-to-book ratio is an eye-watering 43.77. This tells us the market has priced in massive future growth. The debt-to-equity ratio is also quite high at 10.58, and with a beta of 2.123, it's highly volatile. NVDA has shifted between buy and cautious buy recently, with the last one on October 14th being a buy.
So, how do we weigh that incredible growth against the valuation concerns?
Given the exceptional growth and profitability, but also the extremely stretched valuation metrics and high debt, our AI-generated insight for NVDA is a cautious buy. This is a downgrade from its last buy rating, reflecting the increased risk at these elevated levels.
All right, a cautious buy for NVDA. Let's look at American Battery Technology Company, ABAT. This stock has sparked overwhelmingly bullish sentiment. Users are celebrating ABA gains and seeing it as a strong long-term play due to surging national interest in critical minerals. Their Tonopah Flats lithium project is complete, they have a partnership with Call to Recycle, and they've even been included in the Russell 2000. Plus, they've got positive revenue growth of 7.081. That's a lot of exciting news and community hype, Ethan. However, the financial KPIs for ABAT are deeply troubling. The company is unprofitable with an EPS of -0.71, a net profit margin of 0.0%, and a negative operating margin. The debt-to-equity ratio is extremely high at 11.38, indicating a heavy debt load. Its price-to-book ratio of 15.62 is also very high, suggesting extreme speculation. This stock is trading near its 52-week high, and ABAT has consistently been a stay away in our previous ratings.
What's the final call on ABAT then, Brooke?
Despite the strong community optimism and positive project news, the significant lack of profitability and high debt burden mean our AI-generated insight for ABAT is to stay away. Next, we have Trump Media and Technology Corp, DJT. The social media posts we picked up were more philosophical and even jocular in one case rather than direct financial analysis. However, the mention caught our AI's attention.
Yes, and while the posts themselves weren't financially instructive, the company's financial KPIs are extremely clear, Ethan. This stock shows an exceptionally high PE ratio of 180.89 with a net profit margin of 0% and a deeply negative operating margin of negative 49.25. It's unprofitable and destroying shareholder value with negative return on equity and return on assets. The debt-to-equity ratio is an alarming 41.51, and its beta is an incredibly high 4.635, indicating extreme volatility. DJT is also trading very close to its 52-week low. News reports have even referred to it as flailing. DJT has never been rated by us before.
Well, that's certainly a lot to digest. What's the verdict?
Considering the profoundly weak fundamentals and significant financial risks, our AI-generated insight for DJT is to stay away.
All right, let's talk about Archer ADM. One user actually YOLO'd their entire portfolio, seeing a major bullish play around trade wars and domestic production for cooking oil and soybeans. They did highlight a dividend yield of around 3.3%.
That's a bold move, Ethan, and the community sentiment was largely skeptical or even bearish on that specific thesis. Our KPIs echo caution. ADM shows negative revenue growth of negative 4.9%, which is a red flag. The net profit margin is a very thin 1.33. Most concerning is the astronomically high debt-to-equity ratio of 46.798, which signals substantial financial risk. While it has a dividend, the PE of 26.77 seems high for a company with declining revenue and such a leveraged balance sheet. ADM has not been previously rated on our podcast.
So, despite the dividend and a bold bullish call from one user, what's our take?
The weak fundamentals and extreme debt make this too risky. Our AI-generated insight for ADM is to stay away.
Now, let's look to the stars with Intuitive Machines Incorporated Lunner. The post title itself, Trading Lunner Calls, Rocket Moon, implies some bullish anticipation, and we know space stocks have been soaring. They've also had positive operational developments, like achieving CMMI Maturity Level 3 and acquiring Kinetics.
That enthusiasm needs to be tempered with a very clear warning from a user who stated, "Whatever you do, do not hold through their next mission." I'm saying this as someone who got burned in March. 66% of my account gone in under a week during IM2. That's a stark reminder of volatility. Financially, Lunner is deeply unprofitable, with an EPS of negative 3.65 and a negative net profit margin and operating margin. Crucially, it has a negative price-to-book ratio of negative 4.27, meaning liabilities exceed assets. The debt-to-equity ratio is extremely high at 12.83, indicating heavy reliance on debt. Lunner has never been rated on our podcast before.
A 66 loss is significant, so a high-flying sector, but a cautionary tale here.
Absolutely. Our AI-generated insight for Lunner is to stay away. The financial health is extremely precarious.
Finally, let's look at a retail giant, Walmart Inc., WMT. We're seeing WMT gains, Rocket Moon, and calls to get in before it's too late, especially after their partnership with OpenAI for direct purchases in ChatGPT. That's a huge move. They've also shown strong e-commerce growth, up 26%, and solid Q2 net sales up 4.8%.
Walmart is definitely making strategic moves, Ethan, and that OpenAI partnership is interesting. However, the stock is currently trading very close to its 52-week high, so much of that excitement is already priced in. The PE ratio of 38.56 is quite high for a traditional retail company, suggesting elevated growth expectations. More critically, the debt-to-equity ratio is a very high 68.719, indicating substantial financial leverage. WMT has not been rated by us before.
So, even with the AI integration and strong sales, there are reasons for caution.
Yes, the high valuation, limited immediate upside, and significant debt burden lead our AI-generated insight for WMT to be to stay away.
Thanks, hunters. Let's recap our AI's top picks for today's deeper analysis. Investigate as buy, Alphabet Inc., Google. Investigate as cautious buy, Nvidia Corporation, NVDA. Investigate as speculative gamble, American Battery Technology Company, ABAT. And that wraps up another episode of The Daily Hunt for Multibaggers.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. For Brooke, I'm Ethan, and we'll catch you next time on The Daily Hunt.